Welcome to this explainer. Let's get right into it, because today we're setting the stage for mastering the absolute bedrock of Singapore property, the finance side. Look, if you've been following property asset progression for a while, you already know that picking the right property, that's really only half the battle. How you actually finance the whole shebang is where real wealth is either built up or silently drained away without you even noticing. To show you what I mean, I want to anchor this entire discussion on one specific number, $60,000. Why? Because the gap between a 2.8% and a 3.5% loan rate on a $1 million mortgage is literally more than 60 grand over 10 years. I mean, that is pure cash just leaving your pocket. So financing isn't just a bunch of boring administrative paperwork, it's a high-stakes financial strategy. And I think this quote brilliantly captures our core philosophy today. Money borrowed wisely is money multiplied. Money borrowed foolishly is a chain around your ankles. Figuring out the mechanics of your loans, your debt ratios, and your CPF, it's not just about getting the keys to your new place. It's really about avoiding those costly chains and building real, multi-generational wealth. Okay, so here's our roadmap for this explainer. Pillar 1, the first choice, loans. Pillar 2, the constraints, MSR and TDSR. Pillar 3, the hidden weapon, which is your CPF. And Pillar 4, the ongoing strategy, refinancing.
All right, let's jump straight into Pillar 1, the first choice, your loans.
So you've basically got two totally different paths you can take here. First, there's the HDB concessionary loan. This one offers incredible stability. It's got a 2.6% fixed interest rate, which, fun fact, is actually pegged at 0.1% above the CPFOA rate. It lets you take out a maximum loan of 80% of the flat's value, but the absolute massive advantage here is that your 20% down payment can be paid entirely from your CPF ordinary account. That means zero cash is required up front. Zero. Plus, if market rates drop later, you can switch to a bank loan with zero penalties. On the flip side, we have the bank loan. Now, while current rates hover around 3 to 3.5%, keep in mind they are variable after an initial lock-in period, usually 2 to 3 years. And banks are strict. You need a 25% down payment, and a minimum of 5% of that absolutely must be paid in cash. So for first-time BTO buyers, that zero cash down advantage of the HDB loan is usually the winning move. But just a quick reminder, if you're eyeing private properties, HDB loans are off the table, you're going to have to use a bank.
Moving on to Pillar 2, the constraints. We're talking MSR and TDSR.
First up is the mortgage servicing ratio, or MSR. You can think of this as a hard boundary if you're buying an HDB flat or an executive condo during its minimum occupation period. The rule is incredibly simple but very strict. Your monthly mortgage payment absolutely must not exceed 30% of your gross monthly income. Let's actually put some real numbers to this so it makes sense. Imagine a hypothetical couple, Alex and May. Let's say their combined gross income is $8,500 a month. Under the MSR rule, 30% of that gives them a max monthly mortgage payment of $2,550. Okay, so if we plug that $2,550 into a 2.6% interest rate stretched over 25 years, it supports a maximum loan amount of roughly $530,000. Add their 20% down payment on top of that, and the maximum property price they can legally afford for an HDB is about $662,000. See? Very clear, straightforward boundaries. But here's where it gets a little spicy: the total debt servicing ratio, or TDSR. Now, this rule applies to all property types, and yes, that includes private condos. It dictates that all of your combined debt obligations, so we're talking your mortgage plus your car loan, credit card debt, student loans, the whole lot, cannot exceed 55% of your gross monthly income. So unlike MSR, TDSR looks at your entire financial footprint. Let's bring Alex and May back to see how this actually plays out. Their combined income is still $8,500, which means their 55% TDSR limit is $4,675. That's the maximum total debt they can legally carry each month. But wait, they've got an existing car loan that costs $800 a month. We have to subtract that right off the top. That leaves them with $3,875 available for a mortgage. Notice how this number is actually higher than their MSR limit of $2,550. So if they are buying an HDB, that stricter MSR rule is what binds them. But if they were trying to upgrade to a private condo, that $800 car loan would seriously eat into their overall buying power. Listen, if you take away only one thing from this section, let it be this golden rule. Burn this into your memory. Every $500 in monthly debt reduces your overall borrowing capacity by roughly $100,000. Honestly, think about that the next time you're tempted to take out a car loan right before buying a property.
Serious wealth builders know they need to clear those outside debts first to maximize their property leverage.
All right, let's move to pillar 3, the hidden weapon, your CPF.
We're going to run through 4 rapid-fire CPF optimization rules you absolutely have to know. Rule 1. Do not drain your CPF OA completely on your first property if you can avoid it. Why? Because when you use CPF, you have to pay it back into your own account with 2.5% accrued interest when you sell. Preserving it now maximizes your actual cash in hand later. Rule 2. Think about mixing cash and CPF for your down payments. Pulling less CPF means lower accrued interest over time. Simple math. Rule 3. You always need to check the CPF usage limits based on the property's remaining lease. Just use the CPF Board's online housing calculator. There are strict caps, especially if you're looking at older private properties. And Rule 4. Voluntarily top up your OA if you have some spare cash lying around. It gives you a guaranteed 2.5% risk-free return. For safety-first investors trying to build a war chest, that's just an incredible tool.
And finally, pillar 4, the ongoing strategy, or as most people call it, refinancing.
Here's the deal. After your initial 2 or 3-year lock-in period with a bank ends, your interest rate is probably going to reset to a higher floating rate. You can't just set it and forget it. In a competitive market, switching banks can easily drop your rate by 0.3 to 0.8%. Let's make those stakes super tangible again. If you have an $800,000 loan, securing a new rate that's just 0.5% lower saves you $4,000 a year. Let that sink in. Over 10 years, that is $40,000 in pure cash you saved just by doing a little bit of paperwork.
And honestly, it doesn't even have to be a headache. You can turn this whole banking process into a really simple, actionable checklist. Let's assume you've got a 3-year lock-in. At month 30, so 6 months before the lock-in ends, just set a reminder on your phone. At month 33, start shopping around. Go ahead and use a free mortgage broker. They can access deals you won't see publicly advertised. Get quotes from at least 3 different banks. You want to give the new bank plenty of time to process things, which usually takes about 8 to 12 weeks. Then, right at month 36, you switch banks and refinance. Boom, tens of thousands of dollars saved just like that.
By totally understanding your loan choices, respecting the strict math of MSR and TDSR, optimizing how you use your CPF, and religiously sticking to a refinancing schedule, you are actively multiplying your money. But this actually brings up a terrifying final thought. You might have perfectly mastered your loans and your ratios today, but are you prepared for the sudden tax traps, things like buyer's stamp duty or the dreaded ABSD? Because those can literally wipe out hundreds of thousands of dollars in an instant. Make sure you take the time to master that next step on your wealth building journey. We'll see you next time.